Friends, this is Shondipon here again. Today we will be discussing about a very interesting thing, and this is different types of lending rates. Now you may have heard about repo rate and reverse repo rate. Today we will be discussing about different kinds of lending rates in banking system. So first is repo rate. We know about repo rate and everyone knows about repo rates. What is this repo rate? Repo rate is nothing but the banks are taking loans from RBI and that loan interest is repo rate. This is called repo rate. And then we come another one that is called reverse repo rate. So what is this reverse repo? Reverse repo is just nothing. It is just the opposite of repo rate. So what is reverse repo rate? That RBI is taking loan from different banks and that loan percentage is called reverse repo rate. So it is just the opposite. One thing you should remember always, that reverse repo rate is always less. It is always less than repo rate. So repo rate will always be greater than the reverse repo rate. So now we will be coming to an interesting thing, that is different kinds of lending rates that is taking place or that has taken place over time and again, and how RBI has done this thing time and again with their monetary policy. Now the first and foremost thing that I will be discussing over here is PLR. What is this PLR? PLR is nothing but it is prime lending rate. What is this prime lending rate? Now you'll have to understand the development of banking system. How did this banking system develop? The banking system developed with rich people and then it moved on to the poor people. So when the banking system started, the focus was mainly on the prime customers. Who are prime customers? Prime customers means that people who are capable of giving their loans. So from there, this PLR system was there. That is the prime lending rate. Now what is this prime lending rate? What did it happen? I mean, how prime lending rate worked? Suppose there is one person, let's say person A. Person A is having 1 crore, 1 CR, and there is another person B who is having 10 lakhs, let's say 10 lakhs. So if prime lending rate is taking place, then person A will get more preference in the lending rates. Maybe the lending rates will be reduced for person A because this person will have more capability of giving the loans, but B will not get that same rate. So RBI thought that this is something which is not right, and they changed this system to another very important rate, and we have known about this rate. This is known as base rate. Base rate was introduced. Now what is this base rate? We have heard about this base rate. Base rate is the rate under which a bank cannot give any loan. Suppose the base rate is 5%. A bank cannot give loan below this 5% at any cost. The bank will have to give 5% or above 5%. Now this is something very interesting and this is really good. We may think that this is a very good step taken by RBI, and it's naturally a very good step that was taken by RBI. But you will have to understand that base rate is calculated on various factors and various parameters. Now this was not working, and for that reason another very important rate was brought into notice by RBI, and that is known as MCLR. If at this point you are preparing for banking exam, then MCLR is a very important point that you may have to take place, or you'll have to mug up. Let's say you will have to mug up, or you will have to understand what is this MCLR. MCLR is marginal cost of funds based lending rate. Now I will have to write this, so I will be writing it: marginal cost of funds based lending rate. You'll have to understand this. And why am I writing this? Because this is the concept that is taking place at this moment in every MPC, or let's say the monetary policy committee that takes place. Marginal cost of funds based lending rate is decided. Why this was taken place, why this is so important, you'll have to understand this thing. You see that what is this marginal cost of funds? Marginal cost of funds. This is most important term. This is something which have taken place with the evolution of different kinds of loans. If I am discussing about this a marginal cost of funds in this video, it will take lot of time to discuss about this marginal cost of funds. If you want to know in short what is this marginal cost of funds, it is nothing but the amount or the price. Let's say the price which will be important, or the price needed to create $1. The price needed to create $1 in future. This is a business concept, and so in this video I will not be covering this marginal cost of funds based lending rate. You will have to just remember that at this moment the base rate is not taking place, or the base rate has been abolished, and MCLR is taking place, that is marginal cost of funds based lending rate. So this is very important from the question point of view in financial awareness. Now, apart from this MCLR, there are two more important lending rates, and this has been evaluated. The evolution of these two lending rates have taken place because there are so many factors coming in deposits. So I will be discussing about two different lending rates apart from MCLR. I will be writing MCLR over here, and there are two different lending rates. One is RLLR. What is RLLR? This is repo linked lending rate. So you can understand repo linked lending rate. In this lending rate I am not writing over here. So repo linked lending rate. What is repo linked lending rate? Now when the repo rates are increased or decreased, there will be difference in the lending rates. You may have noticed that when repo rates are increased, then there will be increase of lending rates, or the borrowings will be in higher percentage. Maybe the repo rate is at 3%. At that time the lending rate may be 5%. If this increases, I mean the repo rates increase, then the borrowing rates will also increase. This is something which will be called repo linked lending rate. So many banks are also considering this repo linked lending rate. Sorry for this stammering. So I will be discussing another one, that is EBLR. EBLR. I will be discussing about this. This is called external benchmark linked lending rate. LR. I am liking LR. So EBLR is nothing but external benchmark linked lending rate. Now why this has taken place? What is this now? Why so many kind of lending rates have been discussed over here? Now I will be discussing EBLR at this moment in short form. EBLR is nothing but it is something which are externally benchmarks are being used. Fed rates, the repo rate, SLR, that is statutory liquidity ratio, and so many factors are being used, and after that this external benchmark linked lending rate is being used. Now why is this happening that so many kinds of lending rates are being used? So MCLR is there, already there. Now there is introduction of RLLR, and now there is EBLR. You have to understand the concept of deposits. You may think that from where will a person be getting money, or let's say a bank will get money. Bank will always get money from RBI. Let's understand this deposits part, then only we can understand. Banks will always get money from RBI. Now you may see at this moment or at this juncture that much money is transferred from fixed deposit and recurring deposit to mutual funds, stock market. In one word, we can call this capital market, and also in different kinds of instruments like bond market, and also in life insurances. So who is taking this money, or let's say the money that are taking place? I can say MF, that is mutual fund. We can say stocks. We can say life insurances, bonds. So over here the money is there. Now we need money over fixed deposits and also in recurring deposits and also in savings form. But today there are many people who are there who are not having that much liquidity, and they are keeping this in stocks, life insurances, bonds and mutual funds. People are thinking more rationally. So for that reason MCLR is not working. When it comes to borrowing, repo linked lending rate is very interesting, because when there will be different kinds of lending like home loan lending, personal loan lending, car loan lending, or gold loan lending, there are different kinds of advances. So there will be different tenure of advances too. So for that reason we will have to see which one will be working in which place. So let's just put all this out and we will be discussing about this. See, we are discussing about these three factors, this three one. Maybe there is a car loan, a car, there is a house, let's say, and another thing with, let's say, personal loan. So these are different kinds of loans. In personal loan there can be different kinds of loans. Education loans are also there, agri loans are there, but the prime ones which we take, the personal one, house loan and car loan. A house loan will be taking place for maybe 30 years or 25 years. Car loan may take place till 8 years to 10 years. And for personal loan, it can also vary from 7 to 8 years according to the banks, different kinds of banks. Now, if we see a house loan, this is a huge loan that is taking place, and with time, the risks are also there. It's a very important concept that you will have to understand, and for that reason, RLLR can be very good. Another thing you will have to understand is about fixed rate and floating rate. Now I am just putting all this out and we can discuss one thing, that is fixed rate, or say fixed percentage or floating percentage for the borrowing. Let's say a house loan is there, floating rate and fixed rate. A house loan is there, house loan. Sorry about this. Let's say there is a house loan and the fixed rate or fixed, let's say fixed rate is 6%. And for floating rate, what is floating rate? Floating rate can be anything which can be linked with RLLR or EBLR. So if there is fixed rate, let's say 6% or let's say 10%, let's take 16% or 10%, fixed rate can be there. There are floating rates. Floating rates are more flexible and it can be good for customers as well as the banks. So many banks push floating rates to customers because they know that if they follow this floating rate, then only they can reach to a profit making. And for that profit making, for this profit making, it takes lots of efforts. Now if we go to macroeconomic point of view, from macroeconomic point of view, floating rates are very good both for customers and also for banks. But at times fixed interest rates can also give huge advantage. When can this fixed interest rate give you good advantage? When the market is low or when there was pandemic. When there was pandemic, the repo was low. The repo was low. So what happened? The interest got lower and many corporate houses took loans for a good tenure, for a good amount of tenure, and over there they used fixed interest rate. Now one thing you will have to understand is that the fixed and floating interest rate, this can be chosen by the customer. It is not the bank which will be pushing you to give fixed and floating rate. So this is why there is a huge and stiff competition between many banks because they are providing either fixed or either floating rates. So you can see that how profits can be made through this different kinds of lending rates. So in this video, I feel that I have made you understand different kinds of lending rates and how this can impact to the customers and also the banks. How it can impact customers' profitability and also the bank's profitability. Do let here comment below that if you want to know any kind of lending rates apart from it, if you want to know the margin and cost of funds based lending rate in details in the next video, or you want to know any other kind of financial awareness video in the next video. So please do comment over here. Till then, stay healthy, stay safe, and now bidding you adieu. Bye bye.